I think we have to start with with a better understanding of how financial markets operate and what is the relationship between prices in the financial market and the real world. And I think that our current understanding is inappropriate, that the prevailing paradigm of what financial markets are, what their role is, and how they function is actually false. Taken smaller positions and stuck with them. I learned the hard way that the range of uncertainty is also uncertain, and at times it can become practically infinite. Uncertainty finds expression in volatility. Increased volatility requires a reduction in risk exposure. This leads to what Keynes called increased liquidity preference. This is an additional factor in the forced liquidation of positions that characterize financial crises. Right now, everybody talks about imposing market discipline, as if that would take care of everything. I think you need to have an additional discipline, because if markets are inherently unstable, imposing market discipline, you are imposing instability. And how much instability can you live with? So you have to introduce this additional principle. Maintaining stability has to be an objective of public policy. And since we now have a global economy, we don't have the global institutions. We have them on a national scale, and they are working very well, but we don't have the international institutions.
A breakdown in the prevailing world order. Tell me how you see that.
Well, basically, the dollar was the generally accepted reserve currency. Right. And that status is now in doubt, because the willingness to hold dollars has been reduced. And this crisis in particular brings that point home, because each time you have a recession threatening, you've got to lower interest rates, right. Put a lot more dollars in circulation. And of course, as we are heading into a recession, it also puts pressure on the Fed that it can't go overboard in lowering interest rates, because the decline in the dollar then translates into core inflation. Bubbles have an asymmetric shape. The boom is long and drawn out. Slow to start, it accelerates gradually until it flattens out during the twilight period. The bust is short and steep, because it's reinforced by the forced liquidation of unsound positions. Disillusionment turns into panic, reaching its climax in a financial crisis. When the crisis abates and the range of uncertainty is reduced, it leads to an almost automatic rebound in the stock market as the liquidity preference stops rising and eventually falls. That's another lesson that I have learned recently. I also need to point out that the distinction between near and far from equilibrium conditions that I've mentioned was introduced by me while trying to make some sense out of a confusing reality, and it doesn't accurately reflect reality. Reality is always more complicated than the dichotomies we introduce into it.
What happened when you were on such a roll that you began to hit the rough patch?
Right.
What did it do to you, and what did it cause you to question, and how did you come out of it?
Well, first of all, constantly re-examine what you're doing wrong, and you slowly, tentatively get things right. But you can't really get the dynamic going until you have a little profit under your belt, because it's very different when you're risking your principal than when you're risking your profit. So that's how you get these runs, when you get it right, and then you can risk more and make more money. When you have lost it, when you're doing poorly, you've got to retrench. And even as you get it right, you don't get the performance until you can do it on a larger scale.